Hey CMA buddies, let's today start with cost of equity share capital. We'll look at the various computation that's being done for computation of share capital, but with respect to the equity share capital. Prior to this, we have done on preference share capital and the debentures. So today we will start with the equity share, right? Now there are certain methods that can be employed for the computation of cost of equity share capital. Now these methods are as follows. Now if you just look at the various methods, these are called as dividend price approach, earning price approach, growth approach, realized yield approach, and the most important one is CAPM, that is capital asset pricing model, right? So let's start with the first one. The first one talks about dividend price approach, right? As the name says, the cost of capital will be calculated with the help of dividend, right? So let's read the definition. It says if the dividend is expected to be constant, right? That means the dividend doesn't change over a period of time, right? For example, company is declaring a dividend of say 10 rupees per share, then this 10 will be constant throughout the period, as in till the time immemorial. That's what is assumed. So if dividend is expected to be constant, then the dividend price approach model should be used, right? Now this is also called as dividend valuation model. Fine. Okay. How do you compute the cost of equity capital in this? So cost of equity capital is computed by dividing the expected dividend by the market price per share as follows. Fine. So what is the formula like? So when you have to calculate cost of equity in dividend price approach, the formula is dividend divided by market price, which is defined by P0, right? So K is the cost of capital, D is the expected dividend, and P is the market price per share, right? So let's move on to a question so that we can understand it in a better way. Let's look at your question in the book, that is illustration 12, and it says MNC Limited paid dividend per share of rupees 4. Right, so we know the dividend that is being declared is how much? It is rupees 4. Then it says, and the current market price of the equity share is rupees 20. That means the equity price share or the current market price share is rupees 20. Now the question says calculate the cost of equity share capital. Now we can see that what we are given is a dividend as well as the current market price. So the formula in this case for KE. K is what? Cost of equity capital will be what? D divided by P0, or you can even say D1. It's absolutely fine, right? So dividend divided by the current market price, which becomes 4 divided by 20. Since the cost of equity capital is in percentage terms, so we simply divide it by 100. Hence our value in this case will be how much? It will be 20%. That's your answer, right? Okay, let's move on to the next question. It says AB Limited issue shares of 100 each, right, at a premium of 10%, right? This involved underwriting commission of 5%. The rate of dividend expected by shareholders is 12%. Determine the cost of equity capital, right? Now please remember, in this case, whenever we are calculating a dividend is always calculated on the face value, right? Dividend is always on the face value, right? What is the percentage of dividend that's given? It says the rate of dividend expected by shareholder is 12%, right? And what is the face value? It says AB Limited issues shares of rupees 100 each at a premium of 10%. So that means the face value here is 100. So in that case, our dividend amount should be how much? It should be rupees 12. Fine. So our D0 is already there. Okay, what is the next thing? Then we need to calculate what? P0, that is the current market price. Now the current market price is what? It is basically 100, that is the face value, but it says it was issued at a premium of how much? It was issued at a premium of 10%. So 100 plus 10% is how much? Basically 110. But you also need to remember there is an underwriting commission involved in this, right? So basically underwriting commission is the commission charges that is paid, right, for the transaction cost involved in the selling of the shares, right? So in that case, this 110 should be subtracted by 5%. 5%, this is underwriting commission, or what we also call as a flotation cost. So 110 minus 5% of what? 5% of the price of the share, that is 110. So please remember, whenever you are taking underwriting commission should always be on what? It should be always on the face value plus the premium amount. Please don't forget that. Fine, don't just calculate on face value, because eventually it is being issued at 110 rupees. So whatever price you are issuing the shares at, your underwriting commission should also be charged on that. Fine. So this should be how much? It should be 110 minus 5.5. Hence the value of the current market price of the share should be 104.5. Right. I'll quickly recap that for you. Whenever you calculate a dividend is always calculated on the face value. Right. So what is the percentage of dividend that's given? That is 12%. You calculate it on the face value, that is 100. Hence the value becomes rupees 12. Now please remember, in terms of computation of what? P0. P0 is what? Current market price. So how do you calculate current market price? Current market price is rupees 100. That is the face value of the share plus the premium amount, that is 10%. So it becomes 110. Now this 110 needs to be subtracted with what? Underwriting commission. That is the cost incurred with respect to the transaction on the shares. So this 110 has to be subtracted by 5%. 5% of what? The total value of the shares and not the face value. So 110 minus 5% of 110, which is 5.5. Hence the current market price becomes 104.5. Now we can easily compute the cost of equity capital. So K is how much? K is D divided by P0. What is D? D is 12. We've already computed here. And P0 is how much? P0 is basically 104.5. Since we need to know the value in percentage, we simply multiply it by 100. Hence our value should be how much? It should be 11.48 percentage. Right? I guess you're clear with this. Fine. Okay, let's move on to the next method of computing cost of equity capital. This method is called as earnings price approach. Right? Okay, what do you mean by earnings price approach? Earnings price simply means your cost of equity capital is dependent on the earnings that a company is making. Fine. There is no change in the formula. Only thing is you need to replace D by E, where E represents what? Current earning per share. Fine. So we'll read the explanation. This approach correlate earnings with the market price of the share. So in the previous method, what did we see? We saw that the dividends are being correlated with the market price of the share, whereas in this case the earnings are being correlated with the market price of the share. Right? Therefore, the cost of equity share capital under this approach would be based on the expected rate of earnings of a company. Remember, expected rate of earnings of the company. Fine. Okay, so what should be the formula? Formula is very simple. Cost of equity, because it is calculated on the earnings of a company, so it should be E divided by P, where E represents what? Current earnings per share. Earnings per share or current earning per share, what we also called as an EPS. Fine. And then you have P. P we already know what we did in the last method, that is market price per share. Fine. Okay, this approach assumes that the earnings per share will remain constant forever. In the previous case, we assume that the dividend will remain constant forever. Similarly, in this case, we assume that the earnings per share will remain constant forever. The earning price approach is similar to the dividend price approach, only it seeks to nullify the effect of changes in the dividend policy. So it doesn't take dividend policy into account, it just takes the earnings into account, right? Okay, now you need to remember the formula for earning per share. Earning per share is nothing but it is simply market price per share divided by PE ratio, that is price earning ratio, right? Okay, what is PE ratio? P is basically price earning ratio. Okay, PE ratio is something which we can discuss later, but this is for your understanding. If you get any question, please remember that earning price per share is equal to what? It is MPS, that is market price per share divided by PE ratio, right? Okay, let's go on to the question directly. Okay, the question says the earnings available to the shareholders amount to rupees 4,000, right? So the total earnings that is given to you in this question is how much? It is rupees 40,000. Firm is represented by 10,000 equity shares. So the number of shares is how much? Number of shares that is given to you is 10,000. And the current market price of equity share is rupees 25. That means you are given P0 or the P, and that is the current market price, and it is rupees 25. Now what do you need to calculate? You can see there is earnings, there is number of shares, and you have given the current market price. So the only method you can apply for KE can be earnings divided by current market price. Now you need to compute E. E is what? Earning per share. Now how much is the earnings? Earning is rupees 40,000. Since you have to calculate earning per share, right? So the number of shares that is given to you is how much? 10,000. So earning per share will become rupees 4. I hope I'm clear with this, right? Here I have computed what? I have computed E, that is earning per share. Earning per share. The total earnings of the company is 40,000, which is given in the question, and the number of equity shares that the company owns is 10,000. So earning per share, that is for one share, if you need to compute, it should be 40,000 divided by 10, which becomes rupees 4. Fine. Okay, now you need to compute KE. Now KE is very simple. Earning, what is the earnings? It is rupees 4 divided by the price. Price is how much? 25 into 100. So in this case, the percentage should be how much? It should be 16%. And that's your answer. Fine. Okay, now let's move on to the next method of computing cost of equity capital. This method is called as growth approach or Gordon's model. Fine. Okay, what it says, growth approach. So there has to be certain kind of growth, right? Growth in what? Growth basically in the dividend. Fine. Okay, let's read it. Let's understand the explanation. It says, under this approach, dividend growth remains constant, right? You assume that the dividend is constant. Fine. Okay, so the dividend is constant as it is, what we read in the first type. And it says this approach is based on certain assumptions. Now what are these assumptions? It says the current market price of the share depends on the future expected dividend. Right. So if the current market price is based on the future expected dividend, in that case, we have to use the first formula, that is D divided by P0. Fine. Okay, then it says the initial dividend D0 is greater than 0. Obviously, the initial dividend has to be greater than 0. Otherwise, you can never compute the value. And it also says the dividend payout ratio is constant. What is dividend payout ratio? For example, if a company earns say 10 rupees, right, and it is decides to give 4 rupees as dividend. So remaining is what? Remaining 6 rupees, and this 6 rupees is what we call as a retained earnings. That is, the company keeps it to itself for its further development, right? So basically, the 4 rupees that is being paid, this 4 rupees basically the dividend payout. Fine. In that case, the dividend payout ratio is what? 4 divided by 10, which is equal to 0.4. And in that case, in this case, retained earnings ratio is how much? 0.6. So I guess you understand the meaning of dividend payout ratio. Dividend payout ratio is nothing but the ratio out of the whole amount that is being paid towards dividend, right? Here in this case says 10 rupees is the total earnings of the company, and out of this 4 rupees is paid as dividend. Then 4 divided by 10 becomes your dividend payout ratio. This is your dividend payout ratio. Now this is assumed that the dividend payout ratio in this method is basically constant. So this 0.4 will stay uniform throughout, right? Okay, now let's look at the formula. As I said, this formula is more or less similar to the first one, that is the dividend approach or the dividend valuation model. The formula is KE, that is cost of capital, divided by is equal to D1, that is dividend, divided by P, that is current market price. Just that you got to assume the growth, right? Now this growth is what? This growth is the growth rate of dividend, but in this case you need to remember this growth rate is also constant. That means the dividend will also remain constant, whereas the growth will also remain constant, right? Let's understand the various terminologies in this. K is what? K is basically the cost of equity share capital, right? D1 is what? D1 is next expected dividend. We already have read about that. Now you already know, but please remember this is next expected dividend. That is D1. When I say 1, that means the expected dividend. So how do you calculate the expected dividend? Expected dividend is calculated as D1, that is expected dividend is equal to D0. D0 is what? This is the current dividend. So if you multiply the current dividend with the growth rate, that is 1 plus G, you get the expected dividend, right? I hope I'm clear with this. Then you talk about P0, which you already know, that is current market price per share. And since we have referred to G, what is G? G is nothing but the constant growth rate of the dividend, right? Okay. Now, for example, if there is any flotation cost that is involved, that is, there is any charges that is included in case of selling of shares or the transaction pertaining to shares, in that case, that also needs to be taken into account, right? So it says if flotation cost is considered in case of newly issued equity shares, usually the flotation cost is done only in the case of IPOs, that is when the shares are issued in the primary markets. It is not included when it goes to the secondary market or it is further traded. So basically, if the flotation cost is considered in case of newly issued equity shares, then cost of equity under this approach will be calculated as follows. Fine, in that case the formula will change a little bit. What would you do? Simply you will put KE, that is cost of equity capital D1. D1 is next expected dividend, that we have already seen how to compute here. Then the formula will be, generally it is P0, just that you need to subtract the flotation cost from the current market price. So whatever the current market price is there, if you just remove the flotation cost from this, you get the actual CMP, that is the current market price, plus whatever G is there, that needs to be taken into consideration, that is the growth. Fine. So I hope you understand the formula of go-down model or growth approach, right? Okay, we'll quickly revise this. This approach simply assumes that the growth rate of the dividend remains constant, right? This formula is very similar to what the first model, that is the dividend valuation model. What is the formula in that? That was D divided by P0. Just that here you don't simply take D, you take D1. D1 is what? D1 is basically next expected dividend. How do you calculate next expected dividend? You just take the current dividend into account and you just multiply it with 1 plus G. That is the growth that is assumed. Now you also need to remember this growth will be constant throughout. Fine. Okay, so that helps you to get what? D1 divided by P0. Okay, and then you got to also take growth into account. Now when you have to calculate the further like the cost of capital with the help of flotation cost, or the flotation cost is given in the question, in that case the formula remains the same, just that it is D1 divided by P0 minus F. So F needs to be subtracted from the current market price, plus you also got to assume the growth as you generally do in the case of Gordon model, that is G. Hence your formula becomes D1 divided by P0 minus F plus growth. We look at a question, we would be able to understand in a better way, right? Let's look at question number 16. Okay. Now what does question number 16 tells you? 16 says, XYZ company share is currently quoted in the market at rupees 20. The company pays a dividend of rupees 2 per share and the investor expects a growth rate of 5% per year. You are required to calculate the cost of equity capital of the company. Now we'll look at the A part. Now many things are given to us as it is. So basically what is being done is your price is how much? The current market price is basically given as rupees 20, right? Okay, what is the dividend that is given? Dividend is basically how much? Dividend is basically rupees 2. And what is the growth rate that is given? Growth rate is given as 5% per year. I guess all the values are given to you directly. Hence my formula will be KE is equal to D divided by P0 plus growth rate. What is the dividend? It is 2 divided by 20 plus 5%. So if I just simply calculate this, what I get is this 2 divided by 20 is how much? 0.1 plus 5% is how much? It is 0.05. Your value becomes how much? 0.15, or what I can say otherwise is it becomes how much? 15%. Please check in your book. I guess the answer given in the book is incorrect. Fine. So for the first part, the answer should be 15%, right? Okay. Now look at the second part. The second part says the market price per share if the anticipated growth rate of dividend is 7%. Now in this question, what it says is you got to calculate the market price per share. Here he is not asking for the cost of equity capital. B part simply says compute the market price per share. See, you are required to calculate the market price per share if the anticipated growth rate of dividend is 7%, right? Okay, in this case what you should do is, now you got to assume a KE rate because you don't have a cost of equity capital. So we just assume KE from this question itself, that is 15%. Now we know that KE is how much? It is basically 15%. And then what we do is we basically compute the cost of equity capital. Now what is the formula for cost of equity capital? KE is equal to D divided by P0 plus G, as in the case of what? As in the case of Gordon model. Now you know it is 0.15, right? That is cost of equity capital as taken from the last question. You know what is the dividend? Dividend is 2 divided by P0. You don't know P0 because the question says compute the market price per share. So this is the market price per share, right? And the anticipated growth is how much? It is 7%. So this becomes 0.07. If you just transpose this here, then it becomes 0.15 minus 0.07 is equal to 2 divided by P0. So 0.15 minus 0.07 is how much? It becomes 0.08 is equal to 2 divided by P0. Or otherwise you can say is P0 is equal to 2 divided by 0.08. If you just simply compute, the value will come out to be rupees 25 per share, right? I hope you understand, right? I quickly revise that for you. The question says XYZ company share is currently quoted in rupees in the market is rupees 20, right? The company pays a dividend of rupees 2 per share, and the investor expects a growth rate of 5%. So in the first part of the question, what you have been given is 5% per share of growth. Per year of growth, right? So you are supposed to calculate what? Cost of equity capital of the company. So we know the formula is what? K is equal to D divided by P0 plus G. So dividend is already given as 2. The current market price is 20 and the growth rate is 5%. If you just compute, you get 15%, right? In the next question, it is asking to compute what? The market price per share if the anticipated growth rate is 7%. So you got to compute the market price. The condition is this growth rate has changed from 5% to 7%, right? So cost of equity capital you have already computed in the last question. So you take cost of equity capital as 15%, right? And you divide it by your dividend is divided by P0. 2 divided by P0. P0 we don't know. That is what we are supposed to compute. Just that our growth rate has changed from 5% to 7%. So if you just compute this, transpose this here, you get 0.08 is equal to 2.2 divided by P0. Hence your value per share should be rupees 25 per share, right? I guess you understand. Fine. Let's come on to the next question. The next question is using dividend growth model. Fine. Dividend growth model, or what we call as a Gordon model. Cost of equity capital. Calculate the cost of equity capital in the following case. Okay. It says equity share capital is rupees 2 lakhs. Earnings for 21 is how much? It is 60,000. Current market price is how much? It is 180. And dividend per share from 18 to 21 is basically given. So what you are supposed to compute? You are supposed to compute the equity share capital. Okay. Now let's look at the question. Now you know that what is the dividend for the current year. Now dividend for current year is basically given because here you talk about earnings for 21. So you got to take the dividend for the current year. What is the dividend for current year? Dividend for current year is how much? It is rupees 11. Fine. Okay. Now you also know that the price, current market price, that is P0 is how much? P0 here it is given as rupees 180. Now since it talks about dividend growth model or the Gordon model, what we need to compute here is G, right? Because we know the formula for KE with respect to dividend growth model is what? It is D divided by P0 plus G, right? So how do you compute G in this case? Okay, now the computation is very easy because you can see that there are dividends given for 4 years, right? So in that case, the growth needs to be also calculated from this only. Now, since many years are given, the only way you can compute the growth is by calculating the average growth. Okay, how do you calculate the average growth? Let's take 2019 first, right? I cannot take 2018 because I don't have data for 2017. So if I need to calculate the growth, the first year that I can calculate growth is that of 19 only, right? Because I need to have a base year to calculate the growth. Yes or no? So in that case, I'll just do the question. Maybe you'll understand it in a better way. What is the dividend for 2019? It is 8, right? It has increased with respect to what? It has increased with respect to 2018. What was the growth rate? What was the dividend in 2018? It was 7, right? So 8 minus 7. So your growth is how much? 1, right? 1 with respect to what? With respect to dividend of 2018. So this is 8, right? So 1 divided by 8. So this becomes how much? Oh, I'm sorry. 1 divided by 7. Because the growth rate of 2018 is, or the dividend of 2018 is 7 rupees. Fine. Okay. So if I just consider this, this becomes 1 divided by 7 into 100. This becomes how much? This becomes 14.29%. Right. Similarly, I look for 2020. Now 2020, what happens is, what is the dividend declared in 2020? It is rupees 10. Subtract from what? 2019, that is the previous year declared dividend, that is 10 minus 8 divided by how much? Divided by 8, that is the dividend for 2019. So this becomes what? 2 divided by 8 into 100, and this becomes how much? This becomes 25%. Similarly, for 2021, what is the dividend declared? That is 11 minus dividend of the previous year, that is 10 whole divided by 10, right? So this becomes what? 1 divided by 10 into 100, and the dividend growth rate is how much? 10%, right? Now you can see there are three rates that we have arrived on. Because we need to compute growth, what we can do is we can average these three and eventually get the growth rate. It's as simple as that. So what you do is you just simply take the average of all these three. Average of what? The growth. Average of growth is how much? 14.29 plus 25 plus 10 whole divided by 3. So if you just simply compute this, you'll get value as 16.43%, right? So now we know our growth rate for dividend is how much? 16.43%. Fine. Okay. Now let's compute the value of KE. What is the formula for KE? K is simply D divided by P0 plus the growth. Okay. What is the dividend? Dividend for the current year is 11, and the current market price is what? 180. That is P0 plus how much? This is 16.43%. So if you just simply compute this, 11 divided by 180, this should be 0.061 plus 0.1643. Hence the value should come out to be 0.2253, or what we can say is the value of the dividend is how much? The value of the cost of capital, sorry, not dividend, cost of capital is 22.53%. I hope you understand. I'll quickly revise this. What it says is, using dividend growth model, calculate the cost of equity capital. You know the equity capital computation is what? Using dividend model, it is K is equal to D divided by P0 plus G, right? Now you know that the earnings or the equity share capital is 2 lakhs. Earnings is how much? 60,000. Current market price is 180. Actually, the earnings is very much insignificant. This value doesn't hold any relevance, because since you are supposed to use dividend growth model, what you are supposed to know is the dividend. That's more than sufficient. Earning is irrelevant in this question, right? So you know that the dividend for the current year is how much? This is 11, right? Okay, and the current market price, how much is given? It is given as rupees 180. So the next thing that you got to compute is G. How do you compute G? G simply is basically the average of all the years that is given. You cannot compute it for 18, because if you need to compute the rate for growth rate for 18, you need to have data for 17, which is not given in the question. So what you do is you start with 19. So what is the growth rate for 19? It is 8. That is the dividend for the current year minus that of the past year, that is 7 whole divided by 7. This will give you a value of 14.29%. Similarly, for 20 you calculate it as 25%, and for 21 it becomes how much? 10%. You got to take the average of that. So if you just take the average of all these figures, what you get is 16.43%. Now you simply apply the formula and get the answer. The dividend is how much? Dividend is D divided by P0 plus G, which is equal to 11 divided by 180 plus 16.43%. And you know that this is 0.061 plus 0.1643. Hence the value that you get is 22.53%. I hope you understand this concept, right? Okay. Now let's move on to other part of this same question, or the same topic, that is dividend growth model. Now there may be a case wherein you got to estimate the growth rate, now, right? So how do you compute the growth rate? That you need to know. The growth rate more often than not will be given to you. If not given, this is one of the methods through which you can calculate, as in the dividends for various years are given and you compute the average. But if not, that's the way it is given. If it is given in a different way. Okay, so how do you estimate the growth rate? Now the calculation of G, that is the growth rate, is an important factor for calculating the cost of equity share capital, especially in which case? In case of Gordon model or dividend growth model. Now there are basically two methods which are used to determine the growth rate. First method is average method, right? One average method we have already done, right? Now this is other method that we need to adopt. Okay, now if for example there is certain data given to you, that is current dividend is given to you and dividend in n years ago is given to you. So how do you compute this? So current dividend is what? Current dividend d0 is equal to dn. Dn is what? Your past year data plus 1 plus g whole raised to the power n, right? If you just transpose, what you get is under root of n under root of d0 divided by dn minus 1, right? Okay, now growth rate can be also found as follows. Now rather than remembering this method, let's look at these steps. This is very much the copy of this only, just that it is in a simplified form, right? Okay, what do? You just simply divide d0 by dn. What is d0? D0 is current dividend and you divide it by what? Divided by a dividend which was n years ago, right? You find out the result, then refer the FVIF table, that is future value table. Fine. Okay, now you find out the result as found at the step 1 in current corresponding years row. See the interest rate for the corresponding column. This is the growth rate. Okay, let's try to understand this with a question. Maybe it will be more easier for you. Okay, what do? Now let's look at this. It says the current dividend d0 is how much? It is 16.10. Fine. And dividend 5 years ago, this 5 is what? This is the n I am referring to, and the dividend 5 years ago was rupees 10. Now the growth rate in the dividend can be found out as follows. How do you find out this? Okay, now the formula is what for growth rate? Growth rate simply says d0 divided by dn. Okay, now d0 is how much? D0 is nothing but the current dividend, that is 16.10 divided by dividend 5 years ago, that is how much? That is 10. This becomes what? This becomes 1.61, right? Now this 1.61 has to be computed. This dividend was how many years ago? This was 5 years ago. So now you simply go to the FVIF table, right? If you go to FVIF table, that is the future value table, you would see the 5th year, that is the period. Now you can see here the 5th year. Fine. So we just simply come, what is the value that we got? The value that we got was 1.61. So in the 5th year table, you can see that the value here is what? 1.61. Now where do you get this 1.61? This 1.61 we get the rate as what? 10%. Hence my rate should be what? It should be 10%, right? I'll repeat that once again for you. Now how do you compute the growth if you have to estimate, right? Now in that case, what all data will be given to you? You will be given the current dividend and you will be also told what is the dividend per share n years ago. Now in this case, the n years ago is 5 years and the dividend at that point of time was rupees 10, right? You got to calculate the growth rate. How do you calculate the growth rate? Growth rate is simply d0, that is the current dividend divided by the previous dividend, right? So 16.10 divided by 10, which is 1.61. This 1.61 was the dividend. This is the growth rate that is given, not exactly growth rate, this is the value of d0 by dn that you get, but this value is for how many years ago? This is the value for 10 years ago. So you got to estimate the rate taking this into account. For that you need to you need to use the future value table. So if you go to future value table, this is how much? This is 5 years ago. So basically you come to the 5th year period, right? In the 5th year period, you got to track 1.61. Now if you just see, you just run through this table, you would see 1.61 is coming where? Here. Now this 1.61 corresponds to what percentage? It corresponds to 10%. Hence the value should be 10%, and that's how you calculate the dividend. Fine. Or the growth rate of the dividend. I hope I'm clear with this, right? Let's discuss Gordon's growth model. Now Gordon's growth model is again a kind of dividend valuation model only, but there's a slight difference if you compare with the average method. Okay, now what does it say is, unlike the average method, what Gordon growth model does is it basically attempts to derive the future growth rate. So basically it's an anticipation or estimation of the future growth rate. Now as per this model, increase in level of investment will give rise to an increase in future dividend. So as and when your investments are increasing, automatically your dividends will also increase. So if the investment goes up, your dividends are also likely to go up. So that's what Gordon's growth model talks about. Now this model basically takes earnings retention rate, fine, and the rate of return on investments. So the earning retention rate is nothing but it is B, and the rate of return on investment is what? It is called as R, into account to estimate the future growth rate, right? If you remember, we did something called as DPR, that is dividend payout ratio. So for example, the earning of a company is say 10, so this 10 will be divided into two parts. So 4 will be what? It's the dividend that's paid to the shareholders, whereas 6 is what? This is basically the retention ratio, or retained earnings, what we call as, right? So in this case, the DPR, that is the dividend payment ratio, becomes 0.4, whereas the retention ratio, the earning retention ratio, is basically 0.6. So we will be using this concept as far as Gordon's growth model is concerned. Okay, now what is the formula for calculating growth as far as Gordon's growth model is concerned? The formula remains the same as we did, that is K is equal to D by P plus G. Now here we are just computing G through what? With the help of Gordon's growth model. Now in case of Gordon's growth model, if you got to compute G, the formula for G is what? B into R. And as we already discussed, what is B? B is basically the earnings retention rate. Now what is earning retention rate? The proportion of earning available to equity shareholders which is not distributed as dividend. So the 6 that we are talking about, this becomes your B, right? And the rate of return on the fund invested, that is R. Fine. So B into R becomes what? That becomes your growth. Fine. Okay. Now there are certain assumptions that are taken into account as far as Gordon's growth model is concerned. Now this model is basically this follows certain assumptions. Now what are these assumptions? First of all, it is assumed that the firm is an all equity firm. That means there is no debt component involved in it. So whatever portion of finance is there, that is all basically equity based finance, and there's no debt component that's involved in it. Secondly, it says only source of additional investment is retained earnings. So if you have to have some kind of additional investments, that will come only in the form of retained earnings. That means there will be no outside debt or liability that will be taken by the company. Now it is also assumed that every year firm reinvest a constant portion of retained earnings. So whatever retained earnings is there, you keep on reinvesting a constant portion of that. And finally it says retained earnings produced a constant rate of annual return, right? So these are the assumptions on which the Gordon's growth model work. Okay, now if we need to calculate G, then it is B into R. But what is B and R? So formula for B is basically net profit after dividend paid divided by net profit. And if I need to calculate R is nothing but net profit divided by book value of capital employed. Fine. Okay, net profit is something that will be given in the question. But as far as B is concerned, it says net profit after dividend paid. Yes, because B is what? B is earnings retention rate. So what is retained by the company after the payment of dividend? So if I talk about B, then in that case, for example, your earning is 10 and you have paid dividend of 4. Right, so basically your net profit is 10 and you have paid dividend of 4, then and it is fully divided by 10. So this should be 6 by 10 if we take this example, the one we discussed here. Right. Similarly, if you look at R is nothing but net profit. Net profit is how much? 10 divided by book value of capital employed. Now book value of capital employed will be given to you directly in the question, or you can even assume CMP to be book value of capital employed if nothing is given to you specifically. Right. So in this case, we just need to multiply B into R, and this will give us what? This will give us G. Once the G is computed, then you can go ahead and calculate cost of equity capital. Right. Let's come to a question right away so that we have a proper understanding of this concept. Right. Okay. Let's discuss question number 15 of your book. Now the question says Mammon Limited is expected to earn ₹30 per share. Fine. Okay. So that means my earnings is given to me, and what is the earnings? The earnings in this case is how much? The earnings is ₹30 per share. It says company follows a fixed payout ratio of 40%, right? Fixed payout ratio means that is the dividend that will be given to the shareholders. Yes or no? It's a payout ratio. Payout means something which you pay to the equity shareholder. So dividend in this case becomes what? T is equal to how much? ₹30, because you generally pay dividend out of your earnings. So 30 into 40%. Hence this become ₹12. Fine. I guess it is clear till here. And you are also given the market price of the share. So market price of the share is how much? It is ₹200. And it says find the cost of existing equity if dividend tax of 15% is imposed on distributed earnings. right? So what is the tax rate that is given to you? Tax rate is given as 15%, right? But it says 15% is imposed on the distributed earnings when? Okay, first we do the A part. A part says what? Current level of dividend amount is maintained, right? Then you assume that the dividend is basically maintained. Okay, what is the dividend amount that we calculated? Dividend that is calculated is rupees 12. Yes, okay. Then you have to apply tax on this. Okay, now what is the tax rate? Tax is basically 12 into how much? 15%. Yes or no? In that case, this becomes how much? This becomes 1.8. Yes, because it says cost of existing equity if dividend tax of 15% is imposed on distributed earnings, right? On what? On current level of dividend amount is maintained. Fine. Okay, in this case tax is 12 into 15%, that becomes 1.8. Now what will be the retained earnings in this case? The retained earnings in this case is nothing but your total earnings. What is your total earnings? It is 30 minus what is the dividend that you have paid? You have paid a dividend of 12 and there is also a tax deduction of 1.8. Hence my value becomes how much? This becomes 16.2. Fine. Okay. Now you have retained earnings, you have dividend, and you already know the you know the book value of the capital employed. So book value of the capital employed is what? That is the current market price. And what is the current market price? It is rupees 200. Okay. Now let's directly calculate G. What's the formula for G? G is equal to P into R. That is retention ratio into rate of return on the investment. Okay. Now what is the formula? The formula is net profit after dividend divided by net profit. This is what? This becomes B, right? Into R. Now what is the formula for R? R is net profit divided by what? Book value of capital employed. Now you can see here net profit and net profit is squared off. That is, it means it is negated. So what you are left with is net profit after dividend. So what is net profit after dividend? So net profit after dividend is, we already have calculated here. So net profit after dividend is 16.2, right? Why? Because there was a 30 earnings, 12 is subtracted as dividend, and 1.8 is tax that is being paid. So that becomes 16.2. And book value of capital employed, as I said, if nothing is given, you can take current market price as the value. So this becomes rupees 200. And since you need it in percentage, this becomes into 100. So what is the value? So value in this case, if you just compute, you will get as 8.1%. Okay. Now please remember, we have just got the value of G. Now we need to compute KE. Now how do you compute KE? K is simple. What's the formula for K in Gordon model? It's basically D divided by P0 plus growth. Okay. Now what is D in this case? D we have already calculated. D is 12 divided by how much? P0. P0 is 200, right? And the growth rate. Growth rate is how much we computed? 8.1%. If you just overall look at this, the value will be 0.06 plus 0.081. And hence my answer should be how much? That should be 14.1%, right? Okay. Now let's come to the B part. Fine. Okay. What does B part tell you? Let's have a look at the question. It says dividend to the shareholders is reduced by the extent of dividend tax, right? Now you can see now the dividend to the shareholders is reduced by the extent of dividend tax. Now previously the current level of dividend amount was maintained. Here it is being reduced by tax. Okay. Now what do you do in this case? In this case your dividend is reduced by what? By the amount of taxes that is there. That is 1.8. Right. So this becomes what? This is 12 minus 1.8. So the value becomes how much? This becomes 10.2. So now in this case dividend is not supposed to be 12 as we took in the last question. Last part rather. Now the dividend that we need to consider is 10.2, right? But this will automatically make change in what? It will make the change in the retained earnings portion, because now the dividend will not be subtracted from that, right? So this becomes what? This becomes a net profit, or rather I should say G is equal to what? B into R. What's the formula for B into R? Net profit after dividend divided by net profit into net profit divided by book value of capital employed, right? Since we know these both are deducted. Now what is the net profit after dividend? What is the actual net profit? That is 13. But now we simply need to subtract only 12. and not 1.8. Why? Because the tax has already been paid by the dividend holders. Yes or no? Now, as far as the company is concerned, company just need to subtract only the dividend part to arrive at the net profit. So that is net profit after dividend. I hope you understand the difference between both the questions, right? In the previous question, what we did was, in this case, the actual tax was paid by the company. So first, you out of this 30, you subtracted what? You subtracted 12 rupees. That is the dividend that is paid and the tax rate. So that is borne by the company. Hence your net profit after dividend becomes only 16.2. In this question, at the question says that dividend to the shareholders is reduced by the extent of tax dividend. That means the tax burden is taken by the dividend shareholders. Hence my dividend will be subtracted from the tax. That is 12 minus 1.8, that is 1.2. Now when I calculate growth, my B, that is the earnings retention ratio in this case, will be 30 minus only 12. That is only the dividend that is being paid and not the tax amount, right? Okay, divided by 30 into 30 divided by book value of capital employed, that is 200. So this we already know that it is being cancelled. So this value will be what? This value will be 30 minus 12 is how much? 30 minus 12 is basically 18 divided by 200 into 100, right? So I guess this will come out to be 2 9s are 18. Hence value of my G here will be 9%. Now simply apply the formula and get the value of KE. K is what? K is simply D1 divided by P0 plus growth. What is the dividend? Now please remember, dividend that we need to consider is only 10.2 and not 12, as we already discussed, because the dividend is being deducted by the tax component. That is, dividend, the tax portion is being borne by whom? It is borne by the equity shareholders. Divided by what? 200 plus growth. What is the growth? That is 9%, right? So in this case, the value that you will be getting is 0.051 plus 0.09. Hence my value of KE will be what? It will be 14.1%. I hope you understand this question, right? Now let's move on. And then there is something in your book which is called as a realized yield approach. There are no immediate questions that are following this, but we will discuss this method. If subsequently we get any questions, we'll solve that, right? Okay, realized yield approach is what? It simply says, according to this approach, the average rate of return realized in the past few years is historically regarded as expected return in the future. So it assuming that whatever return or the average rate of return that you got in the past few years, that will again be your expected return. Fine. So it computes cost of equity based on the past records of dividend actually realized by the equity. So that means all the returns that you get will determine the expected return in the future. Now, it is easy method for calculating cost of equity capital. Under this method, cost of equity is calculated on basis of return actually realized by the investor in a company on their equity capital, right? Okay, how do you compute it? Here the formula K is equal to present value of what? Of the discount factor into D. Now this basically D is dividend per share. Now this present value will be usually given to you in the question itself, right? So if you got to compute KE, in this case you simply need to multiply PVF, that is present value of discount factor, into dividend per share, and you will get the value of KE, right? Okay, now we come to the most important part of this entire topic, that is cost of equity capital, and that is called as CAPM, that is capital asset pricing model approach, right? Very important, and more often than not you get questions on this. Please understand this concept clearly, because in your final also you have a dedicated concept chapter in a topic called as, or a subject called as SFM, that is strategic financial management, where CAPM plays a very important role. Okay, now what is exactly CAPM? Now CAPM model simply says the risk return trade-off for the securities, right? So basically it tells you what is the risk that you need to take to get a certain amount of return. Fine. Okay, it describes the linear relationship between risk and the return of securities. Right? Linear relationship means what? Linear relationship simply means, for example, this is a graph. So if a graph moves like this is basically a linear return, right? That is constant return. Simply does try to indicate to you that higher the risk that you take, the higher the returns you get. It's as simple as that. That's what is a linear return, rather, right? Okay. Now, what is this concept all about? This risk is the risk is to which a security is exposed. Security is nothing but a stock, right? For example, if you take a Reliance stock or an Infosys stock, there is a risk that these stocks carry. So basically CAPM model describes the risk that a stock carries. Fine. Okay, this can be basically classified into two groups, right? Now what are these two groups? One is called as unsystematic risk, and the one is called as systematic risk. Okay. Now what is unsystematic risk? So unsystematic risk simply means company specific risk, right? So any risk that is very much specific to a company, that means the risk that only a company carries, that is called as a company specific risk. Now this can be reduced by what? By diversification of securities portfolio, right? Now for example, there are two companies, right? For example, we take two paint companies. One is say Asian Paints and one is say Berger Paints. Now these both companies belong to the same category of or belongs to the same sector, right? Now for example, there is some internal conflict in say Berger Paints. There is some union issues, right? And you have only this stock, fine. But overall if you see, the sector is actually doing well, right? So that means to average the returns of your portfolio, now what you need to do is you can hold both Asian Paints and Berger Paints, because the Berger Paints isn't doing well but Asian Paints is, eventually its higher return will negate its low return and you can average this out. So this is basically mitigating the risk. So that mitigating the risk is what this is being talking about. Mitigating means reducing the risk. So that is basically an unsystematic risk. So basically if you have a company specific risk, that is called as an unsystematic risk. In case of this, Berger Paint is basically carrying that, but this can be reduced by what? By diversifications of securities portfolio. So if you have Asian Paints also in your portfolio along with the Berger Paints, whatever losses are being made because of this paint company, this will be compensated by the other one. So that is basically mitigating the risk by what? By diversifications of your securities portfolio, right? Now we come to something called a systematic risk. Now what is exactly systematic risk? Any market specific risk, right? It is non-diversifiable. Why it is non-diversifiable? For example, if you are tracking the stock markets right now, you would have seen that in 2022-23 there was a Russia-Ukraine war, or for that matter in 2020 you had COVID, right? Now in COVID what happened was everyone was selling their stocks, right? So this problem was not very company specific. This was this was an issue or a risk that is basically to do with the entire country or the entire world. This risk is beyond the reach of a company. So this risk also automatically becomes systematic risk, right? So risk which is there in the market itself, that is called as a systematic risk. If the risk is there in the system itself, then what can a company do? If the share price is falling because of the market circumstances, then it's very obvious all the shares in the Nifty or Sensex will also fall. So that's basically a systematic risk, because all the shares are following or all the shares are falling. You never have an option of basically mitigating the risk, right? How would you mitigate? If everything is falling, anyways the returns are going to be low only. So in this case, if you buy Asian Paints or Berger Paints, it's not going to make any difference because both are going down. So this is basically a cause of systematic risk. So basically, hence it is assumed that it is non-diversifiable. Now what are the various reasons why a systematic risk can appear? It can be due to inflation, it can be due to government policy, or it can be due to interest rate, etc. Fine. Okay. Now let's move forward. Now CAPM is concerned solely with non-diversifiable risk, right? So basically CAPM talks about what? Non-diversifiable risk. What is non-diversifiable risk? It's basically a systematic risk, right? So non-diversifiable risk is assessed in terms of what? It is assessed in terms of beta, right? So this is very, very important. Please understand, CAPM is wholly concerned with what? It is concerned with the systematic risk, right? Now basically a non-diversifiable risk or a systematic risk is basically assessed with what? It is assessed with the help of something called as beta, right? Okay, now let's understand the formula of cost of equity capital in case of CAPM, right? So what is the formula? Formula is RF, that is rate of return, or the risk-free return, we can say, right? Any instrument that carries risk-free return. For example, I can say you have put an amount in FD and FD carries 8%. There's no risk in this, yes or no? Whatever happens to the market, right, it is immaterial. This 8% that you have put in a bank FD, you will get it come what may, yes or no? Okay. plus what you called as beta. Now please understand what exactly is beta. Beta is nothing but beta basically indicates the volatility. Okay, now volatility is what? Volatility is basically movement, right? For example, you have Nifty 50. Fine. Okay. Now, for example, if Nifty 50 is going up, Nifty 50 is nothing but simply, if you don't know what exactly is Nifty 50, Nifty 50 is basically top 50 stocks with respect to market capitalization of India, right? So it will have all the blue chip companies like Infosys, TCS, HDFC, ICICI, Reliance. So basically the top 50 companies in terms of market capitalization will form a part of Nifty 50. Fine. When you go further, you would understand this, but just for your basic understanding. So for example, if Nifty 50 is going up, and for example, the rating of this Nifty 50 is say 1, right? Now, similar with respect to this Nifty 50, there is a stock called as say HDFC. So the movement of Nifty 50, if it is say 1, and the movement of HDFC is also 1, that means it is said that the beta of HDFC is equal to that of Nifty 50, right? Now, for example, there is a stock called as Bajaj Finance, and this Bajaj Finance has a movement of not 1 but 1.4. In this case, it will be assumed that the beta of this stock is higher than that of Nifty 50, that is 1.4. Right. Similarly, there is a stock called as ONGC, that is Oil and Natural Gas Commission. So in this case, we assume that their beta is say 0.7. So the volatility of the stock with comparison to Nifty 50 will be lower, right? So higher the beta, higher the volatility, lower the beta, lower the volatility. As simple as that. So basically the risk that you carry by taking Bajaj Finance into consideration will be higher as compared to that of ONGC, right? This is the basic understanding of beta. Right. Okay. So basically, cost of equity capital is what? It is basically RF. RF is what? RF is basically risk-free return, right? Plus beta, that is the volatility that a stock carries, into RM minus RF. Now, what is RM minus RF? RM minus RF is basically the market risk premium, right? So RM is what? RM is basically the rate of return on the market portfolio. That is the stock portfolio that you have. That is basically RM. You subtract the risk-free return from that. Risk-free return is what? The return rate of say 8% that you carry on bank's fixed deposit. So what is the volatility with respect to RM minus RF, plus what is the risk, what is the return you will short get, that is RF, right? So you are definitely going to get this risk-free return, yes or no? This FD rate you will get come what may, plus the volatility that you carry, that is beta, into RM minus RF. So whatever is the balance is this with respect to the beta plus the RF, that becomes your cost of equity capital, right? So simply to understand, the formula is KE is equal to RF plus beta into RM minus RF, right? Now we'll start solving the question. You would be able to understand it in a better way, right? Okay, let's look at question number 18. Question number 18 says what? From the following information, determine the cost of equity capital using the CAPM approach, right? So what is the cost of equity capital in case of CAPM approach? KE is equal to what? RF, that is risk-free return, plus beta into RM minus RF. Now let's look at the question whether we have all these values or not. Okay, it says required rate of return on risk-free securities 8%. So we know in question RF is given as how much? It is given as 8%. Risk-free securities. Required rate of return on market portfolio of investment is 13%, right? So that means RM is given to us, right? So what it says return on market portfolio. So return on market portfolio is how much? It is 13%. And you also know the firm's beta is 1.6. So the beta value is given as 1.6. Simply put in the values in the formula and you can get the answer. Hence it becomes 8 plus 1.6 into 13 minus 8. So this is how much? 8 plus 1.6 into 5. So this is 8 plus 1.6 into 5 is how much? 1.6 into 5 is 8 again, right? So my KE, the cost of equity capital, is 16, or we can say 16%, right? Okay, I hope you understand. 19 question, I'll come back to it later, right? Let's discuss 20th first. Okay, when I talk about 20th question, it says calculate the cost of equity capital of Mammon Limited, whose risk-free return equals 10%. So RF is given to me how much? It is given to me as 10%. Firm's beta is 1.75. So firm beta is given as 1.75, and the return on the market portfolio equals to 15%. So RM is basically given as how much? 15%. Now simply putting in the values, what is the formula for KR? K is RF plus beta into RM minus RF, right? So RF is how much? RF is 10 plus beta is 1.75 into RM, that is 15 minus 10, right? So simply knowing this, 10 plus 1.75 into 5, hence my value should be how much? It should be 18.75, right? So that's the answer for this question. Let's move on to the next one, that is 21st. Okay, now what does 21st question tells you or asks you? If the risk-free return and the market rate of return of an investment are 14% and 18% respectively. So basically RF is given how much? It is 14%, and market return, that is RM, is given as how much? It is given as 18%, right? So it says calculate the cost of equity share capital. Look at the first part. First part, K is how much? RF, that is 14 plus, what is the beta? It is 1, right? This is RM minus RF. So it simply becomes 14 plus 18 minus 14 is 4. 4 into 1 is 4. So this is 4 again. Hence my value should be 18%, right? Okay, the next one is K is equal to RF becomes 14 plus 2 by 3 is the beta, right? Here you can see the beta value is 2 by 3, 18 minus 14. So if you just compute this, you will get at 14 plus 2 by 3 into 4. So if you simply compute this, you get value as what? You get 16.667 percentage, right? Finally, you come to the third part. It says K is equal to RF plus 5 by 4 into 18 minus 14. Hence value becomes 14 into 5 by 4. 5 by 4 means into 4. You just simply strike off, you'll get 19%, right? Now what do you understand from this question? Here you can see the beta is 1, right? Beta is 1 means what? The return of the stocks portfolio is very much equal to that of the actual Nifty, right? Or the actual market, right? So in this case, you would see your market return if will be your total return will be same as that of the market return. Why? Because here the volatility is 1. That means the market is moving or rather the stock portfolio is moving as per the market. So you get 18%, right? Now here you would see the market basically says the volatility is 2 by 3. 2 by 3 is nothing but it is approximately 0.66, right? So that means it is less than 1. Now what did I say? When you take lesser risk, your return is also lower, right? So when I take this as 0.66, my return has come down from what? It has come down from 18% to 16.67%, right? Now you look at the third part. It says 5 by 4. 5 by 4 is approximately what? It is 1 point, somewhere around 4 ones are 4 and somewhere around 1.25, right? Now you can see the volatility is higher than 1. That means the stocks portfolio is basically has more volatility. That means the risk taken is pretty much higher. So when you take a higher risk, in this case your return also becomes higher. So the main purpose of doing this question was to make you understand that when the beta is equal to that of market, the return will also be equal to that of market only, right? But or the rather of the stock portfolio. Now if your beta becomes less, your return also becomes lesser, but if your beta become higher than 1, then your return also increases, right? Okay, let's come to the last question of the day, and in the next session we will do cost of retained earnings, right? Okay, now the question says, from the following information in respect of a company, you're required to calculate the cost of equity using CAPM approach, right? Same CAPM. Formula for CAPM is what? CAPM, you compute KE, and KE formula is what? RF plus beta into RM minus RF. Fine. Okay. Now here what all data is given to us? It says risk-free return is 12%. So RF is basically how much? It is basically 12%. Expected market price of equity share at the end of the year is 1400. Initial price of investment in equity of the share is 1200. Beta risk factor of the company is 0.7, right? So you know that the beta is given as how much? Beta is given as 0.7. Expected dividend at the year end is 140. Okay, so you know that dividend is given as how much? Rupees 140. Now what I need to find out is RM. See, if I just look at this formula, I don't have RM with me. Yes or no? So the basic purpose of the basic idea in this question that I need to solve is, first of all, I need to get the value of RM. Now, how do I find RM? That is the return of the market. Okay. Now, please understand, here certain data that is given to me, so I need to extract this RM out of that. Okay. Now, look at B and C. B and C says expected market price of equity share at the year end is 1400. Yes or no? Okay. Now, initial price of the investment in equity shares of the company is 1200, right? So, if I just simply subtract 1400 from 1200, what I'll get is, I'll get the capital appreciation. Yes or no? See, the stock price as on date is 1400, but when I initially invested, it was 1200, right? So, I get appreciation of how much? I basically get an appreciation of 200 rupees. Yes? Okay. Now, along with this 200 rupees, I got some dividend also, right? So, dividend again is an income for me, right? So, 200 is the capital appreciation, plus I get an dividend of 140 rupees, right? This is whole divided by what? Your initial price, right? Then only you can calculate the returns on that, right? So, if you just simply divide this by 1200, what you get is known as RM, right? I'll repeat that once again. The price of the equity share today is how much? It is basically 1400. Yes or no? And the initial price that I had was how much? Was 1200. So 1400 minus 1200 is how much? This is basically 200. Okay. Now there's a certain dividend I got on the share, and that dividend is how much? That is 140. Right. So this becomes what? This becomes 340. So the total earnings that I have got out of these dividend as well as the capital appreciation is basically 340. Now this 340 is on what? On my initial investment. What is the initial investment? That is 1200. Right. So this basically will give the return of the market, that is RM. So 340 divided by 1200 into 100. Hence my value here in this case will be 28.33%. Right. So now I have the value of what? I have the value of RM. Okay. Now simply we can compute what? We can now compute KE, that is cost of equity capital. It should be RF plus beta into RM minus RF. Fine. So what is RF? RF is basically 12. What is beta? That is 0.7 into RM minus RF, that is 28.33 minus 12. Now if you just simply compute this, you get 12 plus 11.43. Hence my cost of equity capital in this case will be how much? This will be 23.43%, right? So with this we finish cost of equity capital. I guess you would have understood all the topics that's being taught to you. I would rather recommend you to solve all these questions on your own also, and if you have a doubt, obviously it's solved on the video, so whenever you want you can come back and refer to it, right? I'm left with question number 19, which I'll be doing in the next video, and we will be doing cost of retained earnings, right? So if you like this content, please press the like button and do subscribe to our channel for further videos, right? Thank you for joining and happy learning.